Susan, for the opportunity to present my work. And also thanks to all of you for being here. My name is Estelle Sun. I'm from the accounting department. And this paper is joint work with Paul Griffin from UC Davis, Michael Wall, who was our accounting PhD students here, and he is now an assistant professor at Iowa State. So in this paper, we are interested in understanding how financial markets value methane emissions. So it's still very early work. We just had our first draft, so we welcome any comments, feedback, and thoughts you guys have. So here's my plan. I'll begin with some background information on the project here, how we get started on this topic here, and then I will walk you through some data available, how we collect the data to construct our methane emission. I will also show you our sample compositions as well. And after that, I'll briefly talk about the model, followed by the main results. If time permits, I will also touch base on some additional findings we got. So before getting into the detail of the work, let's watch a video about methane here. So methane doesn't usually get as much attention as CO2. So we know that CO2 is the dominant, the number one contributors to global warming. Among like 7 different types of GHG emissions, CO2 makes up about 75% of them. And then methane ranks the second, which is about 15%. And then the third one is nitrous oxide, which is about 7%. And then there are 4 other fluorinated gases. They're very powerful, but in terms of the amount, they're very tiny. So I hope this video will provide some useful context regarding how and why methane matters.
Methane. Its rapidly rising levels in the atmosphere could threaten efforts to curb global warming by mid-century. Scientists and policymakers are urging aggressive action to stunt the output of the potent greenhouse gas. But why is controlling methane emissions so important? Atmospheric methane levels in the last 5 years have risen at their fastest rate since record-keeping began. Methane molecules are more powerful in trapping heat than carbon dioxide, or CO2, meaning it takes fewer of them to cause the same amount of warming. Scientists say they have contributed around 0.5 degrees Celsius of warming so far, or roughly 1/3 of warming experience since pre-industrial times. Reducing methane levels could not only have a more immediate effect than reducing CO2, but according to the United Nations, is likely cheaper. Methane concentrations are also rising faster than any other major greenhouse gas. According to the 2024 global methane budget, 2/3 are driven largely by human activities such as agriculture, fossil fuel activities, landfill, and waste. The report, published every 5 years, found methane emissions from these human activities have risen overall by 20% over the last 2 decades. Nearly 160 countries have pledged to cut 30% of their output levels by the end of this decade. Most of the methane mitigation efforts underway are focused on oil and gas, where emissions are easier to tackle, according to the food-focused investor initiative called BEAR. The remaining third of the world's methane emissions comes from natural sources, such as thawing permafrosts, peat bogs, and wetlands. Animals, including humans, are also the source of methane. While it is easy to measure atmospheric methane, understanding where it comes from is crucial for tackling the problem. Scientists are analysing distinct isotope signatures in methane to investigate whether the detected gas comes from biological sources or industry.
All right, so I hope you find this short video informative. So it highlights the high potency of methane emission, compared to CO2. It's a much stronger type of gas out there, even though the lifespan is much shorter compared to CO2. It also talks about the increasing trend we have been observing for the past few years. and it highlights that the methane emission we're talking about most generated from three major sectors: agriculture, energy, waste, and the landfill. Okay, so some of these elements mentioned in this video here are potentially useful for the data construction I'll show you later on, as well as some of the predictions we developed in the paper. Okay. Thanks. All right, I also want to touch base on some of the terms I will refer to a lot throughout the presentation. I'm sure most of you are quite familiar with this, just to make sure we are all on the same page. So CO2, carbon dioxide, we know is pretty much everywhere, right? It lasts for a long time, hundreds and thousands of years. CH4, that's the methane emission, which is the focus of the paper here. There is something called the CO2e, the CO2 equivalent. It basically measures the impact of total GHG emission with regard to how much CO2 would have the same warming effect. So potentially we can calculate or can convert CH4 into CO2e to make that CO2e equivalent. Therefore, the volumes are more comparable and they are more applicable. And then when we talk about the conversion from CH4 to CO2e, we have to have a conversion factor, right? So that's the fourth term, which is called GWP, the global warming potential factor here. So usually that's the number we use to convert the volume of CH4 to CO2e. And then related to GWP, the global potential factor, is also another term, the time, the horizon we're looking at here. The most commonly used horizon is the 100 years. So here we're looking at over the 100-year period, how much heat a particular gas can trap. Okay, so the higher the GWP within 100 years, that means the more heat that the gas can trap here. More recently, we also look at the horizon of 25 years. That's more relevant for gases with a shorter lifespan, like the methane I'll be talking about here. There are also US EPA. We all know that that's US federal agency. They are responsible for a lot of environmental regulations. They do enforcement as well. They publish a lot of reports. They also run a lot of programs. And one of the dominant or major programs they do is this GHGRP, greenhouse gas reporting program. So in that program, what they do is they require certain companies, facilities, and suppliers to report greenhouse gas emission data to them on an annual basis. And for our paper, our emission data are directly downloaded from this GHGRP. So let me just show you one example to kind of tie all these concepts together. So in this example, the GWP, global warming potential factor for CO2, CH4, and N2O is N2O, the oxide, yes. They are 1 by default, 25, and 273 respectively. So those numbers are determined by the UN's organization, IPCC. It's updated annually. It's widely used globally. So EPA uses the same GWP factors as well. So given those GWP factor, imagine we have a company that emits 1,000 tons of CO2, 20 tons of CH4, and 1 ton of N2O, and 0 tons of other gases. How can we compute the overall greenhouse gas emission in terms of CO2e? So it's pretty straightforward calculation, right? So we have 1,000 tons of CO2 times the GWP for CO2 plus 20 tons of CH4 multiplied by the GWP for CH4, and then 1 ton of N2O multiply the GWP for N2O. So this calculation is pretty straightforward, and that's based on a 100 years horizon. Again, that's what the EPA used for the calculation here.
So,
yes.
how good do we feel about the numbers 125 and 273.
Mhm.
Do those feel like pretty good numbers to try to figure this all out?
I believe like scientists came up with this. The number may change depending on what horizons you have. So that's a problem I will talk about later on when it comes to how investor value the level of emission out there. Because depending on how short or how long your horizon the investor have, they may assign a different weight, right? In that sense, the valuation coefficient may change based on that. Yeah, so I'll come back to some of those points. So the current project is actually built on one of my prior work. So back in 2015, Paul, David, and I, we wrote this paper here looking at the value relevance of total greenhouse gas emissions. In that paper, we didn't try to distinguish the emission type. So we didn't separate out CO2 and CH4 and other things. Instead, we focused on the total level of greenhouse gas emission at a firm year level. What we find in that paper, we show that investors negatively value this, and we frame this as investors believe greenhouse gas emission as an off-balance sheet liability. So what that means is that usually if you think about the greenhouse gas emission, their direct impact is not typically reflected on the balance sheet of a firm. However, from investors' perspective, we think that they still believe the emission level could be a future obligation, a future liability for the firm in terms of like higher regulatory risk for the firm, higher reputational risk for the firm, and also the high technological risk. What we also did in that paper is that we tried to quantify the economic impact, right? So what we did is we calculate that for 1 metric ton of CO2 emitted, the market implied penalty is about $78 per ton. And we kind of think that that number is reasonable. It is broadly consistent with like the carbon internal pricing used by other firms. So more recently, like say, ExxonMobil has been using a carbon pricing of $80 per metric ton for their investment purposes. So that's kind of what we did in that paper. And the current paper is really just an extension to that. And we want to specifically focus on the methane emission here. And we asked 2 main research questions. So one, we want to know if methane emission is priced by investors. And 2, we want to know what this pricing differ from that of CO2. So the reason we think it's worthwhile to look at this methane emission is mostly because of the increasing public attention and the new regulation we have observed in the past few years. I have a few headlines here. So most of this attention happened after EPA's 2016 methane rules. I'll talk about these rules a little bit later as I have an analysis on that. So very brief, so in 2016, EPA released this methane reduction rule. It required companies, for example, to install some zero emission controller in their equipment. It required companies to monitor the leaks they have. They want to make sure that the company has like a very frequent checks over time for repairs, those kind of stuff. So they have this regulation out there, and after that rule came out, it was kind of the first, the most important methane reduction rule we have in the States. After that rule came out, a lot of research report also came out, and they are showing an increasing trend for methane concentrations out there. The top left paper, a very recent Stanford publication in Nature, they try to quantify the social cost of methane emission, and the document is around from oil and gas industry is about like 10 billion annually. And then on the policy front, both US and EU have published regulations associated with methane here. So I talk about it for the US, we have EPA, right? So EPA had their first rule in 2016, and that rule got improved and strengthened over time. And then the better version was just released later last year, 2024. What's happening in EU? They have a similar thing. So EU introduced their very first methane reduction regulation in 2024 as well, targeting mostly energy industry and also the energy inputs from their suppliers. The US rule, the EPA rules, the rule came out in 2016. However, there were significant pushback, reversal, delays due to like litigations. Many things happened after 2016, and depends on which administration we are talking about, their pushback, their reinstatement, their strength, you know, a lot of things are happening in terms of where it is now, you know. So the new 2024 rule just came out, but under the new current administration, it seems that it's going to be a rollback for those rules as well. All right, so that's kind of motivated for our first research question. But more importantly, we also want to understand whether the pricing effect differs between CH4 and CO2. That's kind of our second question here. So the idea we have in mind is the following. Okay, so prior research has already shown that investors significantly value this. They assign a negative weighting to this, and we actually can quantify what is the market implied dollar amount, right? So given that we can easily calculate the amount of methane on a CO2 equivalent basis, you may wonder, can we just imply the market penalty based on what we know from CO2 and simply multiply by GWP of 25 or 87, whatever numbers out there, right? So that's kind of the beginning thinking we start with. We thought, okay, is this worthwhile to analyze this individually, given that we can do an easy conversion between CO2 and CH4? So that's the first questions we had in mind. And then we think more about this, okay, methane really differs in CO2 in a number of ways. And we think those differences potentially have some value implications. All right, so here I kind of compare and contrast the characteristics between CH4 and CO2, and I think all of them potentially have some implications for investors at a firm level. So first of all, we have already talked about potency. For CO2, it has a default value of 1. And then for the CH4, the potency is higher. Over a 100-year horizon, is GWP has a number of 25. So here we have to think about what if investor has a much shorter outlook, right? I mean, shorter than 100 years. If that's the case, then investor will apply a much higher GWP than 25. Then by using the methane number calculated using the GWP of 25, will significantly underestimate the amount of methane that's out there. And potentially that will bias the valuation coefficient I'll show you.
So,
yes.
So the question, just in terms of thinking about investors and how they think about differences between these two things, methane and carbon dioxide.
Yeah.
I mean, one thing that strikes me, it sounds like a lot of the view you've got is that there's a cost lens on this.
Yes.
So I'm worried about regulation, taxes, things like that.
Yeah.
What about the opportunity side?
Mm-hmm.
Is that something being built in? In other words, one distinction I would see between those two products is there's a market, I think, for methane, right?
Yes.
It's used as an input.
There's a market for CO2, but less so for the methane emission. I'll talk about a little why that's the case. In terms of the positive side, one of the benefits I can see will be methane exists for a much shorter period of time. So potentially, if regulation can kick in pretty quickly, you can address that problem in a timing horizon, and you can potentially solve or curb the global warming problem. Okay. But that's actually not what is happening right now. So what is happening right now is that the regulator actually tend to prioritize on CO2. There's actually pretty limited regulation here. The one I'm aware of is just the 2016 EPA's rule. You can see why that's the case, because given the amount of CO2 that is out there, and the CO2 can last for a long time, right? So the regulators actually not prioritized on this as opposed to this. So in terms of regulation, I believe that the uncertainty is much higher for CH4, and also based on the fact that after the 2016 rule came out, there's a lot of pushback about that. All right, and then the other thing, the lifespan, we have already touched based on this. So CO2 lasts for a long time, and the lifespan for methane is actually pretty short. So it's about 10 to 12 years, and the warming effect may be gone by the end of 20 or 30 years. So in that case, from investors' perspective, they may assign a much shorter investor horizon when they do the evaluation for the firm. The other thing we try to argue in the paper is that we think that the future cost associated with mitigating and capturing methane could be higher compared to CO2. So what do we have to know about CO2? The technology is relatively more advanced. The carbon capture has been there for many, many years, and it's pretty mature. On the other hand, if you want to try to capture methane, that's really hard. So usually methane comes from very diffuse sources out there. The concentration is not very high. And more importantly, methane emissions are mostly from the leaks companies have. And the leaks happens not intentionally from the firm, right? The company don't do that on purpose. I want to leak this, right? So usually they don't know where the leaks are, which makes measurement of methane extremely difficult to do. So I tried to search some information about the methane capture technology. It seems that the industry has started on this, but it's very slow, just for the same reason that it's really hard to capture that. Regulation, we talk about this. We believe that the uncertainty is much higher for methane emission. For CO2, there are already a lot of policies from EPA to regulate CO2 emissions. Lastly, so Abby also talked about the trading thing. The trading thing is also pretty mature for CO2. There's kind of relatively liquid market out there for the cap and trade program and the carbon credit market out there. That has been exist for a long time. For the trading scheme for methane, as far as I know, they're pretty new as well. Again, for the same reason here, if we want to trade methane credit, at least you need to measure that at least as accurate as you can. But the problem is that it's really hard to precisely measure the amount of methane emission on a firm year basis. You just don't know where the leaks are. I mean, there are some technology you can use to capture that, but it's way more difficult than the CO2. For CO2 emission, you can really precisely identify the amount, right? And understand fossil fuel goes in, you know the combustion process, you know exactly how much CO2 can be generated from that. And for the methane, it's really hard to identify and to monitor and to track it.
So
yes,
just to clarify, so there's the trading schemes, and the trading schemes help to pull the costs down, I guess.
Yeah, we try to kind of frame this as a potential market opportunity for the firm, because if you think about the carbon trade program or the carbon credit market, by reducing your company's emission, you can actually trade your slave emission for money, right? So that kind of provide incentive for company to lower their emission. So that's a good thing. So it's a good opportunity for the firm, but we think the opportunities may not be there, or maybe you would not.
The one thing I just wanted to clarify, and I might be wrong about this, but I thought there's actually a market that methane is it's a derivative product, right? It's part of the carbon chain, right? So it's a short carbon chain.
Yeah.
I thought there's actually a market for methane
trading
products, right? Not cap and trade, an actual market for this.
Could be.
And so if you can capture it, you can actually sell it, not just in a cap and trade, but actually as a product.
I see.
But that's worth verifying.
Yes,
but
yes.
if it is,
that would be
that's
another opportunity. That would be the positive side. So I'll look into that. so we are not capturing CH4 that are burned to CO2. If methanes are burned and transferred into CO2, that's CO2. That's not CH4. The CH4 we are looking at are purely the leaks we have in the energy system.
Thank you.
All right, so given those kind of arguments we made in the paper, we try to make the point that it's possible that investors may assign a more negative valuation weight to CH4. They may penalize CH4 more than CO2, given the high uncertainty, the high future cost, the high financial risk faced by the firm. All right, so that's kind of motivate our second question. So we thought it's kind of interesting. It's worthwhile to look at the pricing difference between CO2 and CH4. A little bit about our data. So we directly collected our data from EPA's GHGRP program. That program doesn't collect all methanes out there. So they focus on the industrial human-induced methane from the energy system, from the waste and the landfill. So as you can see, the program doesn't include any data on the emission from the agriculture industry, which is a main component for the methane out there. It doesn't cover data on this natural sources. It also has requirement in terms of who needs to report to the GHGRP. It's only for US facilities that generate more than 25,000 metric tons of CO2e annually. So if your facility is below that threshold, then you don't actually report to GHGRP, then that facility will not be in our sample. I think all the pictures and tables are not properly displayed. What I wanted to show you here is that I want to show you the EPA data we get from the GHGRP program. So what's going on here? They report the data at the facility level. The example I want to show you is actually Pfizer. They reported to GHGRP in 2023. On the GHGRP website, it actually shows very clearly for one facility for Pfizer, I think it's in Andover, Massachusetts, it actually breaks down the emission by type. So you can see CO2, you can see CH4, and all the numbers are calculated in a CO2 equivalent basis. So when you pull the data from EPA, EPA doesn't report the raw data. Everything is calculated on CO2e. But if you want to use the raw data, you can actually easily convert it back using the GWP factor published by EPA as well. So they have very detailed information about the emission type, and then they also tell you what's the parent company for that facility and the location for the parent company here. And so that's going to be important to have, because eventually we need to aggregate the facility level to the firm year level. So we're going to match by company's name. Here, yeah, yes.
Sorry, just a quick clarification question. So the EPA requirement, is it just that they're getting facility level data for US facilities, or is it company level? So
it would be US facility located in states.
Okay, so Pfizer's locations or facilities outside the US would not be included.
Will not be here. So for Pfizer, actually, when I checked, there's only two facilities, one in Massachusetts, the other one in Connecticut. And then the way we do it, we just basically sum up those two emission numbers, and then we aggregate that to the parent firm. All right. So in terms of the data here, so we have our sample periods from 2010 to 2022, and then we have more than 4,000 observations, 571 unique firms. So in the paper, we show the distribution by year. So they're pretty much evenly distributed over the year. You're not seeing anything here. I wanted to show, show you the industry breakdown of my sample distribution. Not surprisingly, so the main industry that kind of we make up our sample is the energy firms. So they are like 1/4 of our samples. They also have the highest CH4 emissions. The second one is material industry. So we're talking about chemical industries, construction material. They also have pretty high CH4 emission. The third sector is utility, right? So then their emission level is also very high. It's about 17% of our sample. The fourth one is industrial. So we're looking at the manufacturers of capital goods. So they also have very high CH4. So that's kind of the industry composition. So we actually have 43 industries here. So one thing to note is that even though we're looking at methane emission, which comes from the relatively homogeneous sector, right? They're all from oil and gas. They are from waste and landfill. So they're pretty similar emission. But when we aggregate the emission level from facility to the parent level, we actually see a wide range of industries. So we have, not shown here, we have about 43 industries covered in our sample. So in terms of the model we use for this paper, we borrow the Olson's 1985 valuation model. It's a very simple valuation model here. On the dependent variable, that's price here. And then on the right-hand side, the independent variable, what the model says is that the two fundamental drivers of a company's stock price is accounting book value and future abnormal earnings. That's our two main determinants on the right-hand side. So following prior research, we kind of use the book value of net asset to a proxy for the book value part. We use the earnings per share to proxy for the abnormal future earnings for the firm. So you can imagine it's we regress price on book value, earnings per share, and then we add in two non-financial variables. In this case, that would be the CO2 per share and the CH4 per share, which is the main variables of interest in this work. So when we calculate the CO2 per share, that's the total amount of CO2 in metric ton divided by the number of shares outstanding in thousand. And we do a similar calculation for CH4. But note that when we do the calculation for CH4, those are the CO2 equivalent of CO4. So they're not the raw value for CH4. By doing this, we can actually compare the coefficient between the coefficient for CO2 and the coefficient for CH4, because essentially they're all CO2e. And then the stock price, which is the main dependent variable here. The way EPA works is that they issue the methane data in October of the following year. So we want to make sure that we're assessing the investor's response after the data becomes available. So in this case, we use the quarter end price in December of the following year. So for a company with December 31st, 2020 fiscal year end, EPA issued the numbers in October 2021, and then we use the quarter end price in December 2021. That's kind of the Y variable. So yes.
Can I just make a comment about that for our non-accounting friends in the room?
Sure.
Right, so the Olson and Feltham-Olson models, they're basically the accounting equivalent of the DCF model. And one of the things that those papers showed, they showed basically mathematical equivalence between the two. If you do evaluation using a DCF or you do evaluation based on these accounting models, you get the same valuation. The difference is that you're emphasizing the inputs that are accounting based versus capital based. That's all. And they're both those papers, just to give you an idea, they're both 4,000 or 5,000 citation papers each. They're really big, in fact. That's good.
Yeah, so that's kind of the model we use. I'm just going to write down the model because we'll refer to that later on. So we have a beta 1 coefficient here, and we have a beta 2 coefficient, which is CO2 per share. And then I have the book value of net assets, and then I have the earnings per share, and I have a bunch of fixed effects. It's kind of the model we have. So what is our prediction here? So for our first research question, we predict a negative beta 1. That is, if investors negatively and significantly value CH4. prior research has already shown beta 2 is significantly negative. And then for prediction 2, our second research question, we want to compare the beta 1 with beta 2. So the idea we have is that if investor value 1 metric ton of CO2 similarly with the 1 metric ton of CO2 equivalent of CH4, then the beta 1 and beta 2 could be really similar because they're all CO2e. However, given the 4 or 5 reasons I talked about in the prior slide, investors may penalize or assign a more negative coefficient for CH4. If that's the case, we will expect more negative beta 1 coefficient. That's the slides here. Okay, so luckily this is not a picture. I manually entered the numbers in the table here, so it can be shown. So that's our main result. First of all, let's focus on CO2 per share. That's not a research question or predictions we have in our paper, but we document a significant negative coefficient. And what this 0.083 implies is that for 1 metric ton of CO2 emitted, the market implied penalty is $83 per metric ton. That's what the economic significance we have. And then if we look at the coefficient for CH4, it's much more negative, right? So if you do the calculation, it's more than 6 times higher than the coefficient in CO2. So when we had this result, it just makes us wonder, okay, that's strange. It's really surprisingly big. What's going on? So we're trying to understand, ideally, I thought these two ratios maybe will be similar, given that they are all mathematically CO2e. However, we do show a very large gap here. And potentially our result does suggest that methane investor penalize methane more, but we're trying to understand why. And then we think the 4 or 5 reasons or explanations we talk about potentially can explain the gap here. So if you remember the explanations we have, we talk about the high regulatory uncertainty, high market cost, high cost to capturing CH4. They're all possible explanations here, but they're really hard to test empirically. It's hard to support actually that valid points. So what we decide to do is we are going to focus on with one explanations we had, which is to play around with the investor horizon. Now recall that when we do the calculation for CH4, we just use whatever number provided by EPA, that's 100 years. Of course, investors have a much shorter horizon than that. As a result, we want to see using a shorter horizon, bigger GWP factors whether we can get a much closer coefficient between CO2 and CH4. Okay, so what we did next is that, so this column is a simple copy and paste from the prior slide. I include that for comparison purpose. So what we did here is that everything stays the same, but now I recalculate CH4 per share using a GWP of 87. That's a well-known number given a shorter time horizon here, okay? You can apply even shorter one, what about 10 years, right? We haven't done that. So by simply making that very simple mechanical change, we can see that the coefficient for CH4 and CO2 are already much closer than the one we have here. So one of the key takeaways we have here is that it seems that when it comes to valuation, the GWP factor of 87 is a more relevant factor to use as opposed to the 25 here. All right, so the next analysis, again, I have a picture here, it's not shown. So what we're doing here, we want to know to what extent the pricing effect is driven by the industry level methane versus the firm specific amount. So that analysis is motivated by the prior research, which shows that the emission level tends to be very homogeneous within the industry, but they differ a lot across industries. So to test this question, what we do is we kind of construct 2 new industry level measure here. So in addition to firm level, we now have CH4 per share industry and CO2 per share industry. So that's and we have, I think that's the beta 5. And now we have a beta 6, which is CO2 per share and industry. Okay, so we add this to industry level emission data to the same regression here. So the argument we have here is that if the pricing is mostly driven by the industry level emission, then we will get a negative beta 5 and a beta 6. Beta 5 can be more negative if investor assign more negative weight. After controlling this, this CH4, firm-specific CH4 and firm-specific CO2 may still add incremental power to explain the price. If that's the case, we may still get a 2 negative coefficient here. However, if the industry measure simply just stack away all the significance at a firm level, then we will not have any significance for beta 1 and beta 2. Okay, so here is the result we have after we include the 2 industry level methane variables. As you can see already here, after doing this, the significance for firm-specific CH4 and CO2 are mostly gone. And then consistently, we see that investor has a very negative coefficient for the industry level CH4. So what that means is that it seems that firm level stock price is more responsive to the industry level emission as opposed to the firm level emission. So the next question comes to what Maxine has talked about. That is, what about the political environment, right? That potentially can play a role in the pricing effect we documented here. So in this analysis, we can proxy political environment by looking at the location of the companies, whether they are located in blue state versus a red state. So usually for companies located in a red state, there are more stringent climate rules, and also companies, investors, regulators, they are more likely to support those rules. So we're trying to argue that for company in the blue state, investors may expect higher regulatory or social costs. Therefore, they may penalize more when the company has high CH4. So the way we do it is we kind of separate our sample into 2. We look at a company that have headquarters in blue state as one group, and we also look at a company with headquarters in the red state as another group, and we run separate analysis between 2 groups here. And not only that, we also look at company with facilities in blue state, because headquarters may not be the whole thing. And we have the data on where the facilities are located for each firm. So what we do now, we can construct a continuous variable, we call that facility blue, which measures the percentage of a company's facility located in blue state. So if a company has all of their facility in blue state, that'll be 100% here. So we have 2 blue versus red state variables. So first of all, in the first 2 regression here, that's the headquarter red state sample, and that's the headquarter blue state sample. We show that the coefficient are both significantly negative. We also test the significance between the 2. They're not actually statistically different. So what is saying here is that being simply located or headquartered in a blue state doesn't bring more negative methane penalty. That's kind of the takeaway here. And then what we do is we want to introduce this facility blue variable here to see how this relation may vary based on the percentage of your facilities that are in the blue state. So as you can see, the most significance comes from the 4th column here. So what it's saying here is that if you are a company in a headquarters in a blue state, and then you have a high percentage of facilities that are also located in a blue state, you get the for those companies, we argue that their regulatory costs are much higher, the methane valuation are more negative. That's kind of the conclusion we have. So I have 5 minutes. Okay, so that's kind of one of my last slides. So I talked about we want to look at this 2016 EPA's rules on methane reductions. So what happened here is the rule came out in 2016, but immediately after it came out, there are significant pushback. Like within 2 months, I think 15 states actually filed a lawsuit to sue EPA. They asked EPA to halt the implementation here. They think that it's too costly to do this, and they don't think EPA has the authority to do a rule like this. And then under Trump's administration period, there's significant delays and a rollback, and then under Biden's administration, there are reinstatement of those rules. So in short, what's going on here is that the rule have been implemented for several years. It has been enforceable for several years. However, the compliance actually varied significantly and depends on the delays, the policy reverse, things like that. However, what we have seen, as a result of this rule is that we do notice that the public attention has increased significantly after the introduction of that rule. So what we want to do is we want to use this rule as a setting to understand whether the methane's pricing effect has changed in the post-2016. So after the rule came out. So the way we do it is we kind of divide the firms into treated firms and control firms. And the treated firms are the companies located in the state who support that rules. So EPA actually keep tracks of the data there. They know there are 9 states that are support the EPA 2016 rules, and the rest states are either neutral about it or they oppose the rule. So we identify the treated firms as firms headquartered or have majority of their facilities in the states that support those rules, and the rest companies are in the control firms. So the predictions we have here is that we believe that for treated firms, they support the rule because they expect some future benefit of implementing that rule. And the fact that the rule have been receiving a lot of pushback, things like that, kind of reduce those benefits at the firm level. So as a result, we think for the supporters, because of the high uncertainty, their negative methane pricing effect may be, become more negative in the post-2016 period. And I have a picture here, but you can't see this. I don't have the regression result. I run a very big regression with many 3-way interactions. But the takeaway is that we show that in the post period and relative to the control firms, the supporters, the company who located in the support state, their methane emissions are actually more negative in the post-2016 compared to pre. That's the analysis. All right, so just to summarize, so the one sentence takeaway of this project is that we do show that investors negatively value methane emission, and the valuation impact is more negative than that of CO2. And then we think the results are potentially helpful to a group of audience here. For managers, I think we may come up with a win-win strategy in the sense that by reducing the emission, 1, you can increase your stock price, and 2, you help curb the global warming that's out there. For investor and the managers, for those investors who kind of invest in companies with high emissions from energy sector, potentially when they do the evaluation, they potentially can include the methane emission as a carbon risk factor in their analysis. And then finally, for the policymakers, our current results are kind of aligned with the recent effort from EPA. So the new EPA rule that was released in 2024, it actually imposed a methane charge on large methane releasers. I think it's about $1,600 per metric ton. Okay, so that's just basically came up the new rule. And then under the new EPA rule for methane reduction, they also require EPA to provide more funding to support projects for better methane mitigations or better methane monitoring. I think that's everything I have. Thanks very much, everyone.